We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Rob Kientz from Gold Silver Pros. Thanks for joining me today, Rob.
Hey, Tom. Thanks for having me on. I appreciate it.
Excellent to have you back. So I wanted to start off our conversation today, maybe by getting your take on how traders are shifting their buying patterns in the silver market right now. We've seen a ton of action already this year. It's been a while since you and I have talked. So I wanted to get your take on, let's say, the changes since the last time you and I have spoken.
Yeah, so really to understand the current silver patterns, you kind of have to go back to last year when we had the pandemic and what we saw in the silver market, and it was different than gold. A lot of it was blamed on lack of intercontinental flights and things, and the trade between London and COMEX, and whether that's really true or whether there are other reasons, we can speculate. But once that pandemic hit and the monetary demand for silver started kicking up, this is about the March timeframe, something interesting happened on COMEX, which I hadn't seen in a long time. And that was people on COMEX that are in the futures market here in the US that trade futures were using something called exchange for physical. That's called EFP for short. You can see it on the CME Group's data on the exchange on the web if anybody wants to look at it. But the exchange for physical allows for price arbitrage play between the futures market in the US and the London over-the-counter spot market. And they're different markets. They're both what I would call derivative markets in that not every trade is supported by physical. Most of it is some sort of derivative. So, but there can be price arbitrage opportunities depending upon each local market and demand for that market because they have different characteristics. So the EFP kicked up in March and went for 3 or 4 months. And what that signaled was there were very differing market dynamics going on in the US versus London. And in particular, in the US, we started to see a lot of demand for physical. And I don't mean just through exchange for physical, I mean through retail. And to add to that, the Silver Institute late in 2020 came out with a report, I believe it was November 2020. Silver Institute reported that their demand forecast for 2021 would be that there'd be about another 100, I believe at 10 or 111 million ounces of silver demand in 2021 to take it over 1 billion ounces demanded in a year for the first time. But a lot of that was industrial. If you read that report, some of it is investment demand, a lot of it's industrial. So at the same time, we had people looking at silver as a safety, a place to go for safety, much like they do gold. The industrial demand is really kicking up. And as economies have started to open back up post, the COVID shutdowns, we've had an unbelievable amount of inflation flow into the commodities complex. Not the precious metals, which is interesting. We can talk about that later. But all the other commodities, you look at lumber's up, like somebody reported 4 times year over year. And I don't remember exactly what months those were. They were talking year over year, but I saw that on one of the mainstream financial media outlets. Lithium's up 99%. A lot of the energy commodities are up a lot. So this rebooting of the economy has caused commodity inflation or commodity demand. And about the time all that's occurring in January of this year, we had the silver squeeze movement. So the last trading day of January and the first 2 trading days of February, we saw people buying the SLV. So the SLV is an ETF fund. It is a proxy for silver, although unless you have 50,000 shares or are an authorized participant, you don't actually get the silver. It's really just price exposure vehicle for most people. But it's a way they can get price exposure to silver in a passive format, in like a 401k, or you have a Schwab account and you want to quote unquote buy silver, but you don't want to actually buy silver, you can do the ETF. So long story short, people were buying into SLV. What happened was, and this has come out on a report on the LBMA's website that governs the London OTC market, they admitted that those 110 million ounces pulled out those 3 days of demand for SLV had moved 110 million ounces from the unallocated pool in London over to SLV's allocated coffers. And they said if this went on for 2 more weeks, the entire London market in its entirety would have been out of free silver because they only had 360 million ounces left. So it was about 10 more business days of that demand. And so what we found out was, well, there's not a whole lot of silver backing up the entire London OTC market. And it's one of the 2 major trading hubs for precious metals. The other is, it's COMEX here in the US. And COMEX at the same time, people were standing for delivery on the futures market. They were taking silver off. They took more off last July. Last July was the biggest silver offtake I've ever seen on COMEX, but that stayed it stayed higher than what we had seen every year prior to 2020, the rest of the year. And then it's been pretty high this year as well. So we're seeing a lot of silver taken off. So backtracking to that original silver squeeze, January, February, we started coming out, myself and other people, Chris Marcus, Arcadia Economics, Andy Miles Franklin, many other market commentators, David Morgan, a lot of other people saying, Dave Kranzler, Investment Research Dynamics. We're saying, look, if you go into SLV, you're not ever actually going to get the silver. So if you're trying to actually do a squeeze, or more importantly, if you want the safety of a precious metal, you got to buy the physical. So the change in patterns, I say all of this leading up to answer your question, is the change in patterns was that people have stopped buying the derivatives, the SLVs of the world, and they're moving into physical. So there have been something like 5.7 million ounces of demand into PSLV, which is the Sprott Physical Silver Trust, closed-end trust, which does have more of a direct access to the silver. Now, you still have to be a big share participant to get it, but it's more of a one-on-one. I think one share is worth like 0.38 of a silver ounce. But the way the prospectus is written is you actually have more direct exposure to silver than you do the SLV, the iShares fund, which JP Morgan is custodian of. And so the PSLV is not pulling silver from unallocated London OTC. They will only sell a share if they can get the silver in allocated format and they know they can have it. And they only release new shares at certain times when they can get that increase of silver. Difference in philosophy there. The SLV will say is make sure they want, and they hope they can get it through the unallocated market. There's no guarantee. And the LB may said, well, if they kept that up, they would have bankrupted us. So there is a finite amount of demand that can come into SLV before it cannot get any more silver. So anyway, people started doing that. They started buying it off the retail shelves. We've had retail premiums very high. And that's been the shift. And this wave two that has occurred in May, because May was the 10-year anniversary, the last price crash in silver when it went from 50 to 34. And then later on in the year went from 44 down to, I want to say, high 20s. I have to go back and look at the chart. But it's been 10-year anniversary 2011 when silver last reached its all-time high of 50 and came back down, was May. So May 1st, a bunch of retail buying. Lots of retail buying. So people are now going for the physical. And so again, long-winded answer, but people have shifted from the derivatives into physical, and that's important. Because if we saw on the COMEX and on LB May, they don't have a lot of physical. So if people are actually buying the physical now, that means the available above ground stocks for investors could very seriously erode, and it could cause problems in industry with companies sourcing silver to build stuff like iPhones and Tesla cars.
So Rob, in that February timeframe, we also saw the SLV change their prospectus. What was that change basically signaling to the market?
They changed their prospectus because I think they believed, and this was not printed at the time by the LB, but came out later, they may not be able to get the silver. So they changed their prospectus basically to say this is sort of a best effort type of deal, but we're not making any guarantees. Now, if you actually look at the SLV prospectus from before the silver squeeze, they had like 27 risks in there. And Nick Beresheff, the CEO of BMG Group, and I talk about this all the time. He's been on my program several times. He runs a gold fund up in Canada, and he understands the markets very well because he has to hedge his position in some of these markets. So he understands the mechanics. And he was saying, Rob, the prospectus is written such that there's no guarantee they actually have the silver for SLV because they don't have true audit and management rights over sub-custodians. And they put all these things in here about, well, it may not be the same quality as what you would typically get on an exchange. It may not be as pure. We don't know if they have it. If they don't have it, we don't have liability. So if you're buying to SLV, the underlying asset that's supposed to be backing that is, it's sketchy as to what they have. But then they added something to the SLV prospectus that further diluted the amount of protection you would have in terms of actual real physical silver in the SLV fund. So at this point, what I tell people is it's a very short-term proxy to silver price, but there's other ways to do it. If you just want exposure to silver price, do it some other way, but I wouldn't even do it in the SLV at this point.
So the last time you and I spoke, Rob, we went over a lot of the let's say the explanations for the COMEX, open interest, defined all that stuff. What have you seen? Coming into the end of April, there was a lot of noise made about how much was standing for delivery. How did you see that situation developing?
So we have had, I can actually go to the CME group website and look it up. But I believe we had the first day of May. May was supposed to be the next big trading month. So if you look at the futures markets, every 2 to 3 months, you have a big delivery month. And why? Because it's a futures market. The futures market's for hedging forward price. Let's say you're a farmer and you want to hedge the downside of your price in a commodity, or you're a producer and you want to hedge the upside because it increases your costs. So you want to hedge. And the speculators are the other side of that market, right? And we know there's more speculators than legitimate hedges. So it's largely a gambling casino in a lot of ways. But essentially, every few months will be a big delivery month where people will take delivery, and that's dependent upon the open interest for that, what they call an active contract month. So May was the next big active contract month for silver. And we saw the first day of May, 25 million ounces pulled out, or I should say delivered. Pulled out is not the right term. Delivered. And that was big because by the time May got here, people had rolled to the July contract. So most of the open interest had rolled off. But there was still a huge amount of deliveries. And now I think we're up to like 6,000 contracts have been 6,000 something delivered. I looked this morning. So May was really, when it finally got here, was a fairly thin month, but there was a lot of metal. But what's most important here, it's not the amount of deliveries, because a lot of times deliveries will stay on the COMEX and they'll go into what we call eligible, which is just vault storage. That is a way of pulling silver off the market, but you could put it back on real easily. You just check a box on a form that says, okay, now I want this to go back to the futures market. So it's not difficult to take that vault storage and say, put it back out there for futures trading if you get a high enough price. But what's happened is people have taken the extra step of actually removing the silver off of the COMEX vault completely. And since the last 3rd of February, it's over now 40 million ounces have been pulled off of the COMEX and not coming back. And the last time we saw that amount come off the COMEX is 2016, and before that was after the financial crisis. So in 2016, you had a sharply rising silver price. And so I think people were worried about that, and they were taking their silver and using it. Of course, after the financial crisis, it was investment demand. There is no quote unquote financial crisis going on now like we had in 2008, and after that 2011. And in 2016, we had a sharply rising silver price. We don't have that now. So my question is, what is the catalyst for all this metal to come off of COMEX? And then we don't know the answer yet. But some large entities are taking the metal off of COMEX. So not only are we having it changing hands on the COMEX in terms of deliveries, we're having it actually come off of the depositories, out of that storage. And that's astounding because COMEX has some of the most secure vaults. So does the LBMA. If you're pulling it off of those Western exchanges, you're either using it for industrial demand, or you're putting it someplace you feel is safer from an investment demand perspective.
And as you're touching on all of this, Rob, can you explain to us why the supply is so inelastic, and when this market gets that thin, what could happen to the price? So
silver for 6,000 years has been money. Gold for about 5,000. We've done studies on this. Silver has become very industrialized once about the 1940s and 50s. Once we figured out silver is going to be so important, the U.S. had giant stockpiles, and those have been all drawn down. That's been reported by the Silver Institute, among others as well. So now we're very thin on our silver stocks. And the way that it gets used, like if you take an iPhone, see if I can get it to focus. Yeah, on this iPhone, uses an itty bitty bit, but without that silver, you couldn't have this miniaturized version of the iPhone, which is basically a miniaturized computer. You couldn't have that without silver. You can't do it with gold because it's too expensive. Gold is similar in electrical characteristics and malleability to silver, but it's less conductive and it's more expensive. So what are your next alternatives? You got aluminum and copper. Well, aluminum and copper aren't as conductive as silver either, and it's hard to use them in amounts that allows you to do this. So what happens is you have a little bit of silver used in a lot of things. And so unlike gold, which is mostly stays in some sort of investable format, whether it be bars, coins, or jewelry, a lot of silver is put into landfills. And there will come a time when silver gets high enough, we might go start mining landfills to get silver. And I'm not joking. If it gets high enough, I could see that occurring. Just like you would pull it out of the ground in a mine. If you If you have enough electronics in a garbage and figure out how many grams per ton's in there, you may go cycle through that garbage and get it. That's later on when silver gets much higher. For now, most silver is not produced through primarily silver mines. It's a byproduct of like copper, lead, zinc mines. And so it's hard to adjust the amount of silver produced every year to meet market demand because it's a byproduct of most mines. And you're not going to increase your copper mining or your lead mining if you need additional silver. There's too much expense there. So long story short, the supply is very thin. The demand is increasing. And remember, I referenced earlier the Silver Institute report that we're going to use 111 more million ounces this year than we have in the past, and it takes it over 1 billion in demand. So we don't have the stockpiles anymore. We know that the COMEX in London are running out because people are investing in it and taking it off those markets. So what happens is you use a little bit of silver like in an iPhone or in a vehicle or in a medical implement or wherever it gets used. And that price of silver could go to $100 an ounce, and they're not going to stop using it in the iPhone. They may raise the cost of the iPhone, $20-30, but people are still going to buy them for the most part. So that's why we call price inelastic. Silver can shoot up in price very, very high, very quickly, but people are still going to demand it because it's not as though you're using 10 ounces in every application. You're using a little bit. So marginally to each product you produce, it's not much. But given that silver is such a small market, that price, if you're talking about producing 1 billion iPhones a year that uses how many ever million ounces, you increase that demand 10% every year, that can spike that silver price because it's such a small market.
So as we look at the silver futures market, Rob, there's no other commodity with a bigger short position than silver. What's the reason for this?
Oh, gosh. So I'm going to give you the answer I believe. If you look at the largest 4 and 8 short positions on the commodities complex, the ones that have the highest concentration of shorts per days of production, meaning if you can look at how much is actually produced, not the dollar amount's irrelevant here. It's how much do we have in the world as an actual physical amount. If you look at that, you see that silver and gold are the two most shorted, concentrated in terms of how, days of production it would take to replace that. I believe it's because they're money, because if you look at the U.S. Constitution, Article 10 says nothing other than gold and silver can be used as money in payment of debt. And they're monetary metals. And if the monetary metals rise too high, then it indicts the dollar. It implicates the central banking system in the fiat dollar. So there is a governmental reason to not allow gold and silver to go too high. And I think for silver, there's an industrial reason because it's used in the space race, it's used in everything technology. And the governments and the world, everybody wants to go to a more technically capable society. So if you let silver rise too far, then it makes it more difficult to do that because there are not as many substitutes. So I think there are multiple reasons. I think the main one is because they're money. But I also think from an industrial perspective, there's reason to keep silver cheap. And I think a lot of people want to keep it cheap. I think China wants to keep it cheap because they're trying to build their middle class. I think India wants to keep it cheap. They're trying to build their middle class. Everybody's trying to get satellites in space to rule the airwaves. Nokia on their website has an article in which they have been given a contract by certain governments to go build wireless infrastructure on the moon. And I'm not joking. It's on their website. So we are pushing into space. That much is obvious. US has got the Space Force. Everybody's launching satellites. We're in the next frontier. We're in that phase of the next, the infancy of the space era of humankind. And you need silver for that. You cannot go into space without silver. So silver is very much a strategic metal. And I think that's why they got it. And it's also money. So I think for those two reasons, they've got to keep the price tamped down.
So, Rob, what symptoms are most telling of the market starting to show that there might be a silver shortage? Do we look at London lease rates? Do we look at premiums on 1,000-ounce bars? What to you signals that we could be coming into this silver shortage?
All of those things. Backwardation on the COMEX, meaning the short-term prices are higher than longer-term ones. That's always a sign in any commodity that you have short-term supply deficits. When that because if you think about it, long term, if you're hedging price, there's more risk long term of the unknown, so the price should be higher. And this is true for bonds or any tradable instrument in addition to commodities. Backwardation means the short-term price goes above. We've seen silver and gold kind of very briefly go into backwardation on the markets. That's a sign that there are supply constraints. So that lease rates, definitely retail premiums, which is your investment demand. The 1,000-ounce bars is more your industrial, some investment demand, but also industrial demand. Those premia, have gone up. So all of those things are signs. The one hard thing, Tom, with the precious metals markets is it's hard to know who has what because of the way that market was built. There are lots of participants and a lot of the audits aren't published, and the chain of title and chain of custody of a specific bar is difficult to track across the different financial markets and different places of ownership. So it's hard to nail down exactly how much we have. We can only guesstimate, but even the guesstimates are showing us that we're heading into a supply deficit. I'll give one resource. Crescat Capital has a chart that they released last year. Anybody can just look this up on Google. Crescat Capital, Gold Cliff. Those 4 words. Crescat Capital, CRESCAT, and Gold Cliff. And you'll immediately get this chart, which shows in 2028, the proven and probable reserves of gold, meaning gold in the ground at the mining companies, and the highest quality of those is called proven and probable, starting to fall off. And in 2030, they fall off a cliff. So our forward inventories of in the ground precious metals are starting to thin out as well. So it's going to be harder as we're using more of these metals to replenish them with thinning proven and probable reserves. So what's going to happen there is the price has to go up as we start to have supply deficits, and more money has to go into mining so we can go start digging more of it out of the ground. And the money hasn't really come into mining yet since 2011. It's never really recovered. That's got to change. And that's where the miners are going to get a boost, is that money has to come in, or else we simply are not going to have enough supplies that we need.
And it's not simply just that it has to go into, the money has to come into mining. It's more that it has to come into exploration as well, right, Rob?
Yeah, that's what I mean. In order to replenish, thank you for making that distinction. In order to replenish reserves, you got to go explore for it. So we know how much we have right now. That's proven and probable, and then a lesser category is measured and indicated. We kind of know what that is. But the thing about gold and silver mines, or any mine, is when you're dealing with a finite resource. I mean, we're not talking about hatching eggs for chickens or growing wheat, which is replenishable. We're talking about stuff in the ground that is not replenishable. You have to continue to explore, and you get the easy stuff first, and then you go for the harder to get stuff and lesser quantity. So as you go along, you have this effect of the prices rise to get it out because you're getting less per ton. And you have to spend a lot more money on exploring to go find those more remote deposits that aren't attached to existing roads and infrastructure. So the costs to get out of the ground are more expensive. And that's where we are. We're in that phase already in silver, and we're about to hit that in gold here in a few years.
So Rob, I know that you're a former auditor, and you're also basically a relentless researcher. And why don't you tell me some things that you've looked at over, let's say, the last year that have really made you shake your head and wonder how best practices from your point of view as a former auditor are maybe not being followed?
Yeah. Oh my goodness. Such a great question. As an auditor, you're taught, I worked at KPMG and Ernst & Young, and then I also worked for some Fortune 20 companies in corporate America in the US, some multi-billion-dollar companies. So I was very fortunate to have that background. A lot of people, they look at auditors and say, ooh, how can you be an auditor? But what you learn from auditing and the professionalism is actually, it's really good. There are life lessons in there that extend beyond auditing, is what I mean to say. So when I look now at things in the precious metal sector and I look at the data, I'm like, how do you certify this data is correct? You look at depositories and their lack of audits on their metal. Do you really have it? It's been 70 years since we've had a public audit of Fort Knox and our gold in the US. It is just all these sorts of questions. And I think what it teaches you, that we have this saying in the industry, trust but verify. After what I've seen in terms of government reporting and the exchanges around the precious metals, I would flip that and say verify and then trust. My trust has gone not to a zero trust model, but very close to a zero trust model. I don't assume a damn thing when I'm looking at a report or numbers. I look at it and say, okay, that's good data. How do I validate this? And we can go into we could branch off into 100 topics here. I would say this: the relationship of the regulatory agencies towards this sector in particular is weak. It's weak at an entity level, and auditors will know what I mean when I say that. If you look at like PCAOB standards, Public Company Accounting Oversight Board standards for US companies, there's something called entity level controls. That's a control at entity level for your business, setting culture and expectations and things like that, and leadership. The regulators of this industry, their entity level controls are very weak. So it starts from the top. That's my overriding comment. And as you get down into the weeds and the details, you see how thin the support is for a lot of the data that is promulgated. And so a lot of that, going back to the commodity sector, there's been increasing regulation dating back to like the mid 1800s, since we really started forming commodities markets. And Jerry Markham did this really cool report in the early 90s where he looked at all of the regulations. And I've shown this on my channel a bunch of times, and I printed it on an article at Seeking Alpha as well, for those of you who follow me at Seeking Alpha. So he looked at 130 years of the commodities market, and every regulation that we created was a result of some sort of malfeasance. So the whole CFTC and the Commodities Futures Act was all created out of previous malfeasance. The problem with the CFTC and the regulators, they lack teeth to really enforce a lot of these markets. So you see a lot of stuff going on that's very sort of sketchy, but they just don't have the right powers. And then recent comments from the CFTC have indicated that they're more serving the big corporate interests than they are serving individuals.
So, Rob, you mentioned central banks in there. Coincidentally, we've seen gold moving from, let's say, the west to the east. These central banks are buying gold and also repatriating their gold. Should this be a signal to the little guy that the big guys are starting to make gold more important?
Yes, gold is important. Most of this is not happening in the West, meaning the US. Most of it's happening in other places. China and Russia are leading. A trick that China and Russia do to underreport the reserves is the central banks don't hold it all. They have it in their sovereign wealth funds, which don't have public reporting requirements. So they have a lot more than they're saying they have. And we've tracked flows in and out of those countries. We know this. So they have really, really bulked up to the point where I've seen people, say that they think China has 20,000 tons of gold. Russia has a lot that they're not reporting. Whether or not that's in their central bank coffers, they have it within their country borders. So those are very heavy gold. Brazil has tried to repatriate, Hungary, Germany, all these. There has been a move in the central banks of the world to get gold either back in their personal coffers away from this foreign storage, or just to get more. And that trend has been since the last financial crisis, specifically since 2011. And if you look at Basel III, these are a set of like international banking liquidity guidelines, Basel III. The third version is Basel III, which came about as a result of the last financial crisis and really was sorted to be promulgated around 2012. And then a lot of it came into effect in 2014. So we've had about 7 years. They've tried to beef up the banking system, liquidity ratios and things to beef this up. And the problem is they keep having to push some of these deadlines back because they're having a hard time making the banking system as liquid and as solid as it needs to be to pass all these new regulations. Part of that is in the gold sector. Gold is now considered a high quality asset where it's held in allocated form and hedged on the futures market. So it's considered, Basel III equal to cash under those two caveats. It's allocated, meaning we're not talking about London OTC market, or we think we may be able to get it on COMEX, we hope and pray. I mean, it's allocated in a storage facility and you're hedging it on the futures market for price risk. It's as good as cash as a reserve requirement. So what that's done is put gold on par with cash. And when we're talking central banks, their main asset is what? It's cash. It's what they produce. So that's an astounding change in the viewpoint towards gold in the world banking system. And I think it's a precursor to where some countries could make gold a support of their currency, or at least supporting the overall solvency of that central banking system. So I think gold has become so much more important for those reasons.
You've taken the time to really look at all of these Basel III regulations, Rob. In your opinion, is this going to be good or bad for the gold price?
I think it'd be good. I did 4 videos on it, and I promised my subscribers I would do something in June because parts of the NSFR in particular are coming to effect in June, even though London's already trying to push it off another year because their unallocated gold market the European Banking Authority looked at their unallocated gold market and was going to give them a haircut of 85%. And LBMA is like, whoa, our participating banks can't have an 85% haircut on gold as a reserve asset. We may have to withdraw from the market and may raise costs. So if you look at what the LBMA has said, it's going to raise costs in the gold market. Some banks won't be able to support it, meaning potentially some supply will go out of the market. So I think it'll be bullish long term. I think Basel III, when it fully does get implemented, whether it's June 28th or later, as it gets implemented, is going to raise the costs in the gold market. It's going to put a tighter microscope on what's actually real gold versus the synthetic unallocated stuff that we're calling gold, but it's not. In other words, it's going to revalue gold for probably closer to what it should be. It's going to happen over time. It's not going to be like June 29th, we flip a switch, but that's where the clock starts. And so that's where the clock starts in terms of gold becoming more one of the pieces of the epicenter of the financial industry and more a realistic price target for gold, rather than suppressed by all these derivatives and all this paper.
You've spoken a lot about the Great Reset on your channel, Rob. What considerations do you think the average person has missed when it comes to this reset?
So if you look at the Great Reset in terms of the IMF, the World Economic Forum, these are the BIS. These are the entities promulgating the Great Reset. This is not a term that alternative media has coined. It's not our conspiracy theory. We're following the publications of these major industries. 2015, IMF published a paper saying we're going to central bank digital currencies. We need to get rid of cash, and we need to go to negative interest rates. And followed that up with a blog post in 2019 saying, here's how you convince people to do this. It was literally the blueprint of getting people out of cash. On their blog post, I covered this for my website subscribers, and certainly people have seen my videos will get the links directly to the IMF. The BIS has come out in agreement with this plan. The 50 central banks, it was reported, I want to say either CNBC or Reuters, I don't remember, I have to go back and look, but one of the major outlets said 50 central banks have signed on to this. So now you see coining of the term digital euro, digital yuan. China is going to be the first to the central bank digital currency race with the yuan. That came out in the news just a couple of weeks ago. They're officially into it. So they're all going to do that IMF plan, and they're all, going to do this reset of the monetary system. They're going to push out cash. That, in their words, not mine. They've even published paper on how long it will take. It takes a generation and a half, but they want to speed this up. They want to push negative interest rates. And in the IMF's words, negative interest rates allows them to control the money supply at an aggregate level. So this is aggregate economics. And they said we can use interest rates as low as we want. And by that, I don't mean bonds. I mean in your bank account. So they're setting up bank accounts to where you put in $100, but they only give you 95. It's a negative interest rate on your bank account. It's an immediate tax on what you deposit. And they said, we can take this as low as we want. If we need that liquidity for other purposes, we can drain people's individual bank accounts by whatever negative interest rate we set. And in the paper, the researchers are quoted as saying this should have no lower bound. So in other words, that is an immediate wealth tax on your labor that you use to earn money that you put into your bank account, and not like they tax you when you die, like an estate tax. They tax it when it goes into the banking system. This is the model. This is what the Great Reset is. It's control of aggregate money. It's so that they can fund whatever program that the governments want. And it's all out in the open. It's all public on their websites. And I'd be happy to provide, links for your viewers to go and read this information for themselves.
So do we have any clues as to what all of these new currency standards are going to look like? And maybe as an aside, Rob, tell us your opinion on if this is going to succeed or not.
So I think all the central banks are kind of doing it their own way. It's kind of like they all have, it's like moving from state to state in the US. You can go to Texas, they have certain laws. You can go to Illinois, they have certain laws. So they're in the general same federated sort of system, but they have different ways of going about things. If you look at the Federal Reserve, they've got the Fed Now program, which is depositing money directly into people's accounts. And, they're looking at the digital dollar in the way that that's done. It's going to be different in China. It's going to be different in Europe, but essentially it's similar type systems. And the way that you trade in and out of these electronic currencies is really going to be interesting. Are we going to go to an exchange rate system? We're going to have the same dollar index, but it's going to be in, federal cryptocurrencies. I don't know. But I do think it's going to reduce the ability of people to save, because you'll lack the ability now to have any control whatsoever over your savings. And whether or not that succeeds is up to the people. In recent videos, I've been repeating this phrase that leads off the Constitution. It's we the people. And, we the people ultimately have the power. I think if you look at history, the people always have the power. They don't realize they have it. They look to their leaders and take their cues. But the time comes sometimes when you have to stand up to your leaders and say, wait a minute, we don't agree to this. And that, in essence, is the U.S. Constitution. The U.S. Constitution says, if we don't feel like leadership's doing the right thing, we can scrub this and start all over if we want. It doesn't have to be a bloody revolution. We can just elect to do it. We're the ones that have the power in that relationship. So to answer your question, will it succeed? Well, that depends on the people. And largely it depends on our education and helping people understand what's happening. And that's why I have an educational website to tell people about these things so that they can make their own choices. Because at the end of the day, I think the people need to have the right to make their own choices. And the governments need to take their cues from the people, not the other way around. Whether or not the people stand up to that system and say, we don't want it, and I honestly do not know at this point. I will say this, that silver movement is tremendously powerful. I was talking about this with some of my friends when we were broadcasting the original silver squeeze. And then we came back for the second one in early May. And we were like, even if we all quit doing this, that movement is going to continue on without us. It's at the point where I could just retire right now and that movement will keep going. So there are signs in which there is, that and the political populism we've seen around the world are signs that people are wanting to exercise their political and economic rights. So I think there are very positive, encouraging signs there, for the peoples of the world to say, hey, we have a voice in this. We want to do it peacefully, but we want to tell our governments what we believe. And this system that you're proposing is not the best for us.
So in September of 2019, Rob, we saw the repo crisis the repo market nearly freeze up. Has this situation gotten fixed, or is there still a risk to you that exists there?
It's not fixed. If you look, it's funny, once that repo crisis hit again, researchers at the National Bureau of Economic, NBER, I'm sorry, I'm going to get that name wrong. Economic Research, National Bureau of Economic Research, published a paper, research they did back in 2011. They looked back at the last financial crisis in 2008, 2009. Guess what led off that financial crisis? I'll give you one guess. It was the repo market. The repo market is what led to the mortgage meltdown. 2019, we have another repo freeze, right? Same cause, not enough short-term liquidity in the overnight markets. So the Fed had to start guaranteeing money in the repo market. And as our current system ages, they can never, ever, ever stop doing this. And in its essence, it's the easiest way to describe it is this. We're in a debt-based money system. Debt grows about 10 times faster than the actual money supply. It goes to do with fractional reserve banking. I'm just going to leave this real easy. So debt always grows faster than money. And so what happens is pretty soon you don't have enough money to service the debt. That's where we are. So that the repo crisis in a nutshell is the recognition of the fact that we're at the end of this debt-based system where something has to give. And no matter how many times they keep trying to prop it up, eventually the mathematics are certain and it's going to collapse. It's just math. And the 2019 crisis I predicted, I went on Lynette Zhang's channel at ITM Trading about 10 or so months before that. And I said, we're going to have a liquidity crisis, a dollar liquidity crisis. Now, I didn't say it would be in the repo market, but I said, we're going to have a dollar liquidity crisis. I explained why. And she looked at me, she said, you're sure we're not going to go to hyperinflation first? I said, watch, we'll have a liquidity crisis first. And it happened in September 2019. And the only reason I was able to predict that 10 months ahead of time is because I understood there's not enough money in the system to service the debt. Trillions of dollars in debt, not as many trillions of dollars in money. And that in a nutshell is, in the most simple sense, is the repo crisis. But we're in that part of the system where it's inevitable. It's just mathematics at this point.
So can't the Fed come in if there does become an issue there, Rob, and provide that liquidity for the repo market at any point, just like they did?
And I think they have been, even though they're not advertising it. I think they're the lender of last resort, and I think that they have to be in there 24/7. It would not surprise me at all if the Fed has a certain group of analysts that are watching that repo market 24/7 all day long. They've got all the alarms going off before it freezes. and they probably have some facility to immediately inject liquidity into that market. That would not surprise me at all. In fact, if they don't, I would call them crazy at this point. Because if you don't, that's the oil in the cogs of the machine. You don't have oil in your engine, you have an oil leak. Eventually the engine's going to seize, it's going to freeze up, and that engine's done, right? So they have to be in there at all times. And yes, they can inject liquidity, but they only have certain ways to do it. If it gets to the point where they literally just have to print off money, then you're going down the road of hyperinflation. So, yeah, they're always going to be there, but at some point that can't get kicked any longer, and the market's going to freeze, and that's coming. And I don't know when. I can't tell you exactly when. I can look at the money aggregates. We can look for signs of the repo market freezing in terms of the overall money rates within that. But that's all we can do. I mean, we don't know exactly when, but we know the mathematics of it are very certain.
Excellent, Rob. Do you have anything else that you'd like to share with our audience as we wrap up here?
Well, just let everybody know, we continue to cover the gold and silver markets on goldsilverpros.com. We do, if you want a paid subscription and do deep analysis, we have the quarterly newsletter, the Golden Quarterly, that comes also with a university course of 39 different courses to help teach people about money and about finance. They're available on the website if people are interested. They just go to goldsilverpros.com.
And you're also goldsilver_pros on Twitter.
That's correct.
Perfect. Thanks for your time today, Rob.
Thank you, Tom, so much. Glad to be back.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.